Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
There was this, there was that. I sat in a room with Meredith Whitney. She was like 18 years old, out of Lawrenceville, PG, Brown University. And Meredith goes, Tom, shut up, invite Visa. Go back and look, folks. It's one of the great calls of the last 20 years. Joining us this morning, Meredith Whitney. Meredith, why are you getting back in the game?
Well, I got back in the game. This is my 2-year anniversary. I missed it. There was so much that wasn't going on in banking and financial services when I stepped away. And so much has gone on, and there was such an opportunity. There's such a vacuum, I thought, in research that I missed it. I mean, this really is my wheelhouse. So I love it. I haven't been this happy in a long time.
So you're following the banks, the financials still?
I follow everything. So basically, I cover whatever I want to. Okay. So one interesting thing, piece I wrote last week was on employment and on inflation that I see. A lot of people talk about inflation around tariffs. I think there's going to be major wage inflation. So what is under discussed is the ICE raids and immigration policies by this administration that's putting real pressure on labor. And Ares Management, an alternative manager, said 2 weeks ago what they see cracks in the economy because workers at low-end restaurants are not showing up to work for fear of ICE raids. And small and medium-sized businesses are losing revenues because of it. And by our estimates, 1 in 4 workers in the U.S. Are Latino and Hispanic. And the BLS counts non-documented and documented work in its 32 million employees that are Hispanic and Latino. And the Pew Center estimates that another 8 million workers are undocumented, and the bulk of those are from Mexico and Latin American companies. So that is going to be a real pressure on rates because it's clearly inflationary.
Meredith, just as you step back here with your wide lens here, what's your view of this tariff policy that we've been seeing from the Trump administration here? We're not really sure, I guess, where it's going to shake out, but there's a lot to take in, I guess.
There's a lot to take in. My impressions when this administration came into office in January was that they were going to focus on deregulation, and that would mean bank consolidation, and be very pro-growth. And they've gone tariffs. I was confused by the methodology of it on Liberation Day. The math didn't make sense to me, and I think that it creates a lot of unintended consequences. Obviously unintended consequences are uncertainty, but also I think you're going to start to see insurance rates go up because the anticipation of replacement costs are going to go up, and that's been one of the most stifling costs for homeowners and for the low end. When you move fast and break things, you have a lot of unintended consequences. I'm not one that can figure out the methodology or the reasons behind it. I have more concerns over it than I do a real understanding of the sense behind it.
So where do we go here for this economy? A lot of folks are talking about a recession. As you look at the broad swath of your coverage, including the big financial services companies, do you see a recession kind of in the near term for this economy?
So all of the technical data shows no evidence of a recession, but a lot of the underlying data shows hints of it, and I think it's more of a stagflation recession, and I very much see a recession, a second recession for the low end in the last 3 years. So the middle class and low end, 52% of households that live paycheck to paycheck we're sick of inflation, voted, I think Main Street voted Trump into office because they'd been through a recession. Their recession occurred when the stimulus money ran out. So after-tax revenues went down by 18%. And they're going to go through another recession because I think employment is going to be a problem in the employment at the low end, and then pressures because there's no wiggle room from income levels.
Across the nation, good morning on your commute. Good morning across America and around the world on YouTube. Subscribe to Bloomberg Podcast. That's the way Meredith Whitney listens to us each morning. Thrilled to have an extended conversation here with Meredith. Meredith, let me go to the wheelhouse. I'm very upset, Meredith, about the way the street quotes yield. I believe it's price lower. Are the major banks, and particularly in the zeitgeist over the weekend, Bank of America, are they at risk not so much of gloom, but just a repricing of their balance sheet because of price down in bills, notes, and bonds?
I think the banks are in a really good place. They're very conservatively accounted for. So where I expect unemployment to go to 6%, their assumptions are north of 7%. So I think the banks are in really good shape. I think that one of the things I'm working on right now is the Fed doesn't necessarily think that banks are in very good shape, and 2/3 of the large banks, the 29 banks that are over $100 billion, are deemed unsatisfactory in terms of rating, and that's going to make M&A very difficult. From my perspective, the banks look very well positioned, and they are very well hedged. So Bank of America does an incredible job, hedging job. And I think the big banks that have hundreds of people hedging their portfolio are in better positions than some of the regional banks that have smaller staffs. So I don't think that's a concern for the banks.
I wanted to go to the regional banks, Meredith, because a lot of folks felt that we had some of the smaller banks over the last several years run into some problems, SVB and so on, and maybe people said maybe there should be some consolidation of the regional banking business in the United States. Do we really need 5,000 regional banks? How do you view that part of the financial system?
I think there should definitely be consolidation, and I think there should be consolidation. And some of the 29 banks that are, 29 of which are in the penalty box that are not allowed to do M&A, should be also allowed to do M&A. They're not above the 10% deposit threshold. They're well below the 10% deposit threshold. So you need healthy banks, and this has been something that I've been working on since 2010. When the big banks, when the regulators wanted the big banks to get smaller, you needed the small banks to get bigger, and that just hasn't happened. And so it's like waiting for Godot for bank consolidation.
To put things in perspective, folks, and Meredith knows it, she lived it. She's big on, forget about all the uproar and bonds and that, and Meredith Whitney notoriety. Visa, the symbol's V, Paul, in case you didn't know that. Meredith Whitney on 57th Street with me with a beverage of our choice. And Meredith goes, Tom, shut up and buy Visa. It's up 1,800%, 23% per year. Meredith, does your vision for the next 15 years, the next 14 years, give you the same uplift in American financial capitalism?
I think there's a lot of really interesting things going on in financial services. Some scary, some really good. A lot of it's going on in the private market. I think the Klarna deal will be a really interesting IPO to watch. I'm pretty in awe of that company. I think Affirm's been a great company. There's a lot of innovation in financial services in the U.S. and the banks are incredibly well positioned. I'd say also, but in fairness, the European banks look pretty good too. They're incredibly well capitalized. So the banking system at large, I think, looks so much better than it did, 15 years ago.
And 15 years ago, Paul, we didn't have private equity or private capital.
Well, that's where I want to go, Tom. Meredith, how do you kind of think about this private credit business, which has really grown so dramatically over the last, 10 years roughly, as an alternative source of capital? How do you view private credit?
Well, I view it uniquely because over the summer, or since September, $40 billion of private credit has been focused on consumer lending. And so this has been like a fire hose of credit within the industry. And a lot of it is private equity-backed companies that are getting forward purchase agreements with private credit, but also public companies. SoFi has over $12 billion of forward purchase agreements from private credit. What that means then is they basically get on a treadmill of gain on sale accounting. So they're out aggressively originating personal loans and home equity loans. And originally I would have thought that would have pumped in a ton of liquidity for the lower end and sustain the lower end, but I think you see fractures within the lower end. That is a potential benefit that could come in and provide liquidity relief. But private credit is, interestingly, never before so interested in consumer finance, and I think that's a real game changer.
Single best buy right now, Meredith Whitney, for old times. What's your single best buy right now?
I love Rocket Mortgage. It's counterintuitive because of rates, but they are the largest home equity, closed-end home equity originator. And interestingly, so I watch, I download the Fed's home equity data every Saturday morning. And what you see, I know, I love it. So what you see is in the summer, home equity HELOCs went from 17 years of decline to expanding, and HELOCs now have accelerated every week since the summer. And what's important about that is that the bulk of HELOCs are being taken out by seniors. So seniors, this is the Fed data, the May Fed data, New York Fed data. 42% of home equity products are seniors, which is counterintuitive because 2004 it was 19%. So more seniors are stretched, and they're turning to products like home equity. And Rocket's going to be the one-stop shopping.
It's too much. Meredith Whitney, thank you so much for joining us this morning. She was a nerd when she was Big Red at Lawrenceville.
Sure.
Complete nerd.
Absolutely.
Meredith Whitney, what she reads Saturday morning?
I don't know.
The Fed something?
Yeah.
She probably reads the minutes of the Fed.
Exactly.
Meredith Whitney, thank you so much for being with us today.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is the interview of the day, folks. For those of you looking at price down, George Bory joins us, Chief Investment Strategist, Allspring Global Investments. I'm going mental. I like the acclaimed Liz Goldenberg, who sold thousands of Bloomberg terminals with a YA function. The media does yield. And what Liz Goldenberg would say, shut up, Tom, it's about price. Are we at a point now, George, where there's a price decline enough out in the yield where it's really starting to hurt people and institutions?
Yeah, price has become very volatile over the last couple of years. And as you point out, those bonds that were issued, 5-10 years ago went down quite a bit in price. And when yield is low, you have a lot of sensitivity to changes in price. That's the bad news. The good news is yields are high. And that is the good news. And so when we have days like today, when we have more volatility in the market because Moody's downgrades the U.S., not new news, but a reminder, yields go up and income is your friend.
So I get what you just said, but for our audience out there like me, less sophisticated, are there going to be losses in fixed income, or do you downplay that versus the yield opportunity?
The yield dominates in this environment. And even if bond yields, so if the 30-year were to go up to, say, 5.5%, which is not out of the realm of possibility, you're still looking at positive returns in bonds. And that's why year to date, bonds have done exactly what they're supposed to do. That income is carrying the day. Your sort of average, bond performance is up about 2% year to date. Not wildly exciting, but enough to beat cash and certainly enough to beat equities in a market where the market's trying to figure out what the growth trajectory is going to be on the back of tariffs. So what I tell investors, what I tell our investors is two things. One, income is your friend. Number two, diversify that duration and then let the bonds do their job. They're doing exactly what they're supposed to do. Income, coupon, compound through time. If I can compound my portfolio today at, say, 5 to 8%, depending on what kind of bond I buy, but if it's 5.5 to 6, I'm doing just fine. And just sort of, you can't ignore price changes in bonds. The price change only matters if you decide to sell it. If you hold on to the bond and you continue to compound, your performance and the return improves as you move through time. And that's the very powerful message in bonds.
This is like a religious experience.
It is.
It's amazing.
I mean, these guys actually, now people want to talk to them at cocktail parties because they actually have yields and returns. Before they were ignored for so long. 30-year U.S. Treasury north of 5%. What does that tell you?
Yeah, it tells you a couple things. It tells you that, the market's clearly, it's clearly sort of pricing in more term premium, on the notion that inflation is uncertain, as you guys have discussed with many guests earlier today, that the fiscal position of the federal government is still sort of stretched and getting stretched even thinner, and that there will be a tremendous amount of government supply over the coming weeks, months, and years. And so as a bond investor, I want extra premium to be able to protect against that. In the extreme, you could sort of talk about vigilantism. I don't think we're quite at that point yet, but bond investors are voting with their feet and they're saying, I need more premium to lend long. And I think that makes a lot of sense given the quality of the lender. But as you get up into that, say 5, 5.5, maybe as high as 6, we don't think that's likely in the near term, but 5.5% with a 2-year pegged at about 4 does actually make a lot of sense. And a very steep yield curve, gives both the economy an opportunity to sort of continue to migrate through tariffs and for investors to make money.
Sweeney's been lecturing on this. Folks, you don't see this. We're on commercial break. Sweeney gets out for Bozy and lectures me. We're at a 210 spread for global Wall Street at 52 beeps. What's normal? 100?
Normal is 100. Yes, and we could get there. If you look at the with 210s, 5s, 30s, 5s, 30s is at like 90, and we think you could get up to 150. So 100 to 2s, 10s, 150, 5s, 30s, not unreasonable. And we think that as we sort of migrate, as the Fed stays kind of stuck in neutral, the wait and see sort of mantra is going to hold for the foreseeable future. And the long end is pricing in both the supply story, inflation uncertainty, and at the end of the day, the U.S. is not the only country out there sort of borrowing lots of money. We know that the Europeans are going to be borrowing more money. The Japanese already borrow lots of money. And so as a lender, we're in a good spot. I want to lend at higher yields. These yields are now attractive. The real yield, as we've talked about many times before, is strongly positive. And again, another central message to bond investors is that your objective as a bond investor is to beat inflation over time. And you have 2 tools to do that. One is income, and then other is duration, the price change on the bonds. Right now, price change is kind of working against you, but income, income and yield is working for you. And so, again, another sign, another message is that you buy fixed income for the income. And that's what works.
Are you telling your clients to take credit risk?
We are taking some credit risk. Credit quality is pretty good, particularly in the world of investment grade. We want to manage that duration pretty cautiously. So lower quality, much shorter in duration, closer to the front end of the curve, longer duration, and higher quality investment grade. When you divide the corporate market like that, you have very generous income at the front end and a nice diversified pool of duration at the long end. And when you diversify that duration, both domestically in the US as well as internationally, if I pull in some German bonds, some UK bonds, some gilts, and I attach that to some corporate bonds, that de-emphasizes the need to hold lots and lots of treasuries. And as we know, the Treasuries got a lot of pressure on it. So there's a lot to do in bonds.
Absolute clinic. George Bory, thank you so much. Chief Investment Strategist, Allspring Global Investments on their fixed income team.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Dean Kernet joins us, Macro Risk Advisors, MRA. Dean, I'm just going to cut to it with the bond turmoil that we see. You have a beautiful, really interesting sentence where the market creates the risk for the system. The internal dynamics that you look at MRA every day, do you see that internal system? Is it fragile?
Yeah, I think, Scott Bessent recently called the U.S. Markets anti-fragile, and I would really disagree with that. There's two certainties in life, death and taxes, but I think we have to add a third, which is just ongoing and extremely large auctions of U.S. Treasuries. The world is awash of them, and there's no obvious solution at hand. And I do think, Tom, market prices are kind of blaring here and telling us something. And the thing about market prices is they're both a response. They react to what investors do, but they also create risk. And I think with respect to the back end of the bond market, now we're above 5% on the 30-year. We're doing this amidst a lot of discussion about a Fed easing cycle, right? Treasury bond yields were rising in 2022, but that was a tightening cycle. The Fed was well behind the curve, and you knew the short rate was going up quite a bit, and the long end followed. Here you have, if you look at the Bloomberg WIRP page, you'll see the market's handicapping easing, but the back end is its own thing right now. There's a risk premium there, and I think we're coming out of this tariff uncertainty. The downgrade doesn't feel good. And so I think that, to me, becomes one of the bigger risks for the stock market is, frankly, the bond market itself.
So talk to us about the state of the bond market, because we saw it kind of freeze up in April, and we got some of that around Liberation Day, really unusual trading there that you don't normally associate with the U.S. Treasury market. What does that tell you?
Right. So if we look at that chaos from April 2nd, Liberation Day, to April 9th, which is the Nevermind day, where Trump basically undid those 5 days of big risk off. You had a rising VIX into the 50s, got as high as almost 60 intraday, and rising Treasury yields. That's not a combination you see very often. And, I think over time, as John was referencing, this gigantic supply of Treasuries has sort of reduced the risk offness, meaning the ability for the Treasury market to serve as a flight to safety asset. Right. It's no longer doing that. So I think that's what we have to appreciate.
Let's go off of last week's single sentence. Kenneth Rogoff, for my book of the summer, Our Dollar, Your Problem. Fabulous foreign exchange, linking it into, this time is different in the system. The fact is, Professor Rogoff modeled out a 5.5% to 6% 10-year yield. Yep. Is that even in the Dean Kernet frame of reference?
Yeah, I think so. So Ken reached out to me on this book as well. I had him speak post the 2011 Eurozone crisis at a couple of events I hosted. Our dollar, your problem, our debt, our problem. And I think, so that's a little bit of a different take on it. I would say, up at 5.5%, 6%, the math of running the interest costs through that debt structure is just remarkably different. There's really no resemblance to the current structure of U.S. interest rates relative to when we took on all the debt in 2020, which, look, was an emergency. We were trying to push back against COVID. But I think the 10-year traded as low as 55 basis points. Into 2021, the 10-year yield was 1.2% at the lows. And so this bears no resemblance to that. And these interest costs are punishing. Tom, you have me on here to talk about the VIX, and whenever we talk about volatility, we talk about things like nonlinearity. And with regard to Treasuries, I think that's a facet of the market that we typically wouldn't characterize as having a risk of, but things gradually, then suddenly, as
okay,
Hemingway said.
Paul wants to jump in. I'm sorry, I'm going to interrupt. This is really important. Where's the suddenly clicking? Give me a 10-year level.
Well, I wouldn't. I would just say
not to 1/100 of a point a tenth.
Exactly. Let me give it to you within 3 basis points. Here's what I would say: we should be watching certain markers. I think you can learn a lot from correlations, and I think when we observe a day like today, which is a stocks down, rates up day, and that's not amidst a Fed tightening cycle. So 2022, we had plenty of those days. Stocks down, rates up. The tightening cycle was unwelcome. The dollar was tightening. Today, we have a very different mix. We have a weaker dollar. We have higher rates, a higher VIX, and lower stock prices. So that combination is new. I think it's a little dangerous. And so, Tom, not to duck the question, I think it's a difficult one, but I think we can learn a lot about the reaction of the stock market and stock market volatility, things like the VIX, to higher yields. So let's watch correlations. Let's look for days like today when rates are going up and the VIX is rising as well.
What do you make of the U.S. dollar? We've seen stocks and other risk assets kind of rebound to a certain degree, but we have not seen the dollar really rally here. What's that tell you here?
And that goes back to what's different, in the rates going up period of 2022. Rates and the dollar were traveling together higher, and that posed a certain risk. This last round of dollar weakness, especially the one that occurred in that, again, chaotic period between April 2nd and 9th, it kind of tells us something. There's a lot of discussion about, a negative branding exercise for the dollar. It's probably too much too soon. I think the reserve currency is not going away. I read with great interest the Moody's downgrade. They talk a lot about the debt stack and the, unsustainability of it. But they also do mention that the U.S. is a economic superpower with the reserve currency. So I don't know that that's going away anytime
Do you
soon.
see a legislative path, like it came up not once, maybe twice this weekend, a Social Security reform? Can there be some drama of debt and deficit maturity? I don't mean duration maturity, I mean behavioral maturity. Like, can we find a debt and deficit adult out there? I don't think there's much evidence we can.
Right. I mean, one we can find is Michael Bloomberg himself, who posted that, I thought, very well crafted op-ed on the terminal yesterday. And I think, the commentary there is that the deck chairs are being shuffled, but really ineffectively. The horse trading around, SALT versus Medicaid work requirements and EV credits, it's just moving things around a little bit, but there's not a lot of impact. I just think these things are intractable problems, and there are other intractable problems out there as well, things like climate change. You have a lot of agency cost with this. And what I mean by that is there's a short-term pain for a potential longer-term gain. And it's difficult to convince people to take that on. So from a hedging standpoint, from a defensive standpoint, I think you have to keep your eye on assets like gold. Bitcoin is a lot of things. It's obviously very speculative. I think it has to have a little bit of a place in the portfolio to hedge against this. And then we got to really think about things like volatility, which to me is the only anti-fragile asset. It benefits from uncertainty and shocks.
Is the stock market about being careful of acquiring certain companies? Do you just avoid the stock market given the bond turmoil?
Well, I think, there's very few benchmarks as amazing as the S&P 500. This index delivers the goods year after year. And so I think it's very difficult not to continue to be invested. I do think, having a little bit more cash on hand makes more sense. Having these other alternative assets like Bitcoin and gold, I think makes sense. And then, again, I'm speaking my own book here because I specialize in hedging and volatility, but investors have got to understand how to use things like options because when you have the potential for the bond market to misbehave as it appears to be doing, that could spell disruption for the stock market.
So how do you think about, again, we've got the VIX here, still below 20, 19 and change here. Is that a healthy level of volatility in the equity markets? Is that something we should be concerned about?
I think that's right about the long-term average. It's right around 20. And of course, you've had these periods of 10. You had an 80 in the GFC, an 80 in COVID. You're coming off something that was very high. And this was a very interesting risk event because it was created by Trump and then undone by Trump. I think the tariffs are a little bit less of a risk now. I'm a little more concerned about the bond market. Paul, I think the question is the cost of hedging a good deal? And I think it's pretty fair. Markets, to sustain a 20 VIX, you need the market to move around at kind of 1% a day, which we got today. And, that to me, that's a couple of small moves and then one big move every 2 weeks or so.
David Gura, thanks for listening to the program this morning. Mr. Gura emails in, says, ask Dean about the cost of summer camp. Let's get an update right now. We're sliding into the beginning of the acquisition of summer camp merch to take to camp. It's out of control.
Summer camp.
Thankfully,
my kids are out of summer camp.
They're out of summer camp.
I have a summer intern working for me, my son Liam. Okay. So that cost is out of control.
Whoa. More than pizza, I hope.
He gets free lunch included in his internship.
So out of a booth school, like you, did you throw Sheldon Natenberg with him? Is he reading about option and all the Greek letters?
We're starting with Rich Yamarone's book on economic indicators.
The late Rich Yamarone, a giant at Bloomberg.
Yes.
Missed every day.
Yes.
That's good. So you start with Rich Yamarone and you got to get to the Greek letters with the child.
Maybe next summer.
Oh, come on, toughen up. Excuse me, is the intern doing work from home?
No, he's coming to the office.
That's how you do it.
Dean Kernan, thank you so much. Macro Risk Advisors, we protect the copyright of all of our guests. His work is hugely valued on Wall Street.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Tina Fordham with us. Tina Fordham, Global Foresight. Thrilled that she could be with us this morning. Tina, I don't even know where to start other than in watching the incredible emotion at Vatican City yesterday. The one nation not represented, it seemed, was Russia and Putin. How removed is Mr. Putin from the Western dialogue on this Monday morning?
Well, I mean, Putin has created his own reality, hasn't he? And I think if we look at the last week, we can see Putin sidestepping just about every opportunity to do what he's always said he wanted for Russia, which is to restore it to being a superpower, as it was during Soviet times and indeed during the Russian Empire. But he was absent from Istanbul and absent, as you said, at the Vatican. So he's laying low.
Where's Mr. Rubio fit into this? I had not one, not two, but three people ask me this weekend. The president will have a phone call with Mr. Putin today. Fine. Okay. But where is the Secretary of State in this debate? Or is he just removed aside and is Mr. Trump his own Secretary of State?
Well, it's a very good question that I think we can link back to the conversation with your last guest as well. We are trying to read the tea leaves and understand who has what brief, or is President Trump kind of, acting as his own counsel? And the meeting with his special envoy, Steve Witkoff, the subsequent meeting that he was supposed to have at the Kremlin was canceled. So I wonder if Trump is going to end up being frustrated after this conversation because, in dating terms, what Putin is doing is called breadcrumbing.
And what does that mean?
A little trail, just enough to keep you going, but no lunch.
So
no sandwich.
I love that. How cute.
Exactly. So if you're President Trump, how do you approach this here? Because on a campaign trail, obviously he was speaking very confidently about his ability to end this war, and he's got to maintain that commitment here. Where does he go?
Well, I mean, I don't know that President Trump feels that he does have to maintain the commitment. He's expressed frustration with Putin. He had previously, to great effect, expressed frustration with Ukrainian President Zelensky. Putin will be hoping that the United States moves on, loses patience, and leaves this to Europe. And so I expect that, we'll get what diplomats used to call a candid conversation. Putin might agree to something. The Istanbul meeting yielded a prisoner exchange, but he just needs to keep President Trump feeling like he's listening. And I think his appetite to continue at this stalemate level is almost indefinite.
So again, if you're President Trump, do you have any leverage here to kind of move this forward? Because again, it seems like one of the issues he certainly campaigned on.
So yes, I mean, President Trump has threatened secondary sanctions in kind of out loud musings. So he does have further sticks. I'm not sure that the president will want to go that far just yet. And remember, of course, that President Trump has just come off the back of what was a very successful trip to the Gulf,
Right.
where he was, received with the kind of
Right.
tribute and deal bonanza that he likes to see. So his patience might be a bit thin today for this conversation.
Years ago, Tina Fordham, I was sitting in an overpriced Mayfair restaurant with Jonathan Farrow, and he from the Midlands of England explained to me that fishing rights on the North Sea is like religion. So I guess we had an agreement overnight that nudges back to pre-Brexit over 0.04% of the British economy. Explain to our American audience the religion of fishing rights between France, Netherlands, Belgium, I don't know, Norway, I don't know what, and the United Kingdom. Explain the importance of that.
Well, fishing rights and, agriculture are so often the kind of electrified third rail on these agreements between EU member states. And now, 9 years after Brexit, the UK trying to find ways to, frankly, make up lost ground. The figure that you gave about the tiny, percentage of the British economy that's dependent upon fishing is accurate, but like farming in the United States is very emotional, and especially for those, really quite marginalized communities in the Northeast and elsewhere where fishing matters. But I think we have good news this morning generally. Again, the economic toll from Brexit and that attempt to unscramble the egg between the UK and its largest trading partner, the European Union, has hit this country hard. So there's a lot of effort in the media to say this is, kind of rejoining by the back door. I think it's good news for slow growth Europe. And call me old school, but I think more trade is better than less.
Tina Fordham, thank you so much. Tina's too young to remember Captain's Courageous, Spencer Tracy, 1937. Every kid had to watch the movie. We were ordered at gunpoint to watch the movie. If you don't behave, you're going to end up on a fishing boat off Nova Scotia. Tina Fordham, thank you so much. Really appreciate that.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us right now to get to the market open, Jamie Patton, co-head of Global Rates, TCW, is way. Jamie, is it a global lift in longer-term yields and price down?
What we think is really interesting, that's obviously what we've seen, especially if you look at the change in the market since April 2nd, Liberation Day. But what if you came into the market on April 2nd and we didn't have all this wild volatility, rates spiking, equities getting crushed, Trump listing a list of tariffs that was out of this world? What if you just came in and said, here's the deal, and Trump had listed the tariffs that we see today? So the average effective tariff rate is up over 10% to 14 to 18%. That's up from 2.3%. We have this kind of 60 to 90 day rolling volatility. would stocks have rallied and now be less than 4% from the all-time highs? Would rates have bear steepened by 20 to 50 basis points? It's hard to imagine that would be the market reaction had this just been the simple announcement. The average investor prior to April 2nd expected tariffs to only go up to like 10% average effective rate, and we're much higher than that right now. And this is the bottom. We're still dealing with 60 to 90 days of uncertainty. So what we think is really interesting about this rate move is that it seems like the result of wild volatility and sequencing that really matters rather than a reaction to actually what we have in this macro environment today.
So, Jamie, we look today at the 30-year U.S. Treasury north of 5%. Does that mean anything to you guys? Do you guys have internal emails saying, oh my goodness, did you see where the 30 years today?
We certainly talk about it. We don't see a ton of value in 5% 30 years. We see a ton of value in the front end of the curve. And that's because in this environment with fatter tails, rising volatility, we expect term premium. And when I say term premium, it sounds fancy. All that means is how much should you get paid to take incremental risk? That should be higher. You should get paid a lot more money to take 30 years of US Treasury risk than you should 2 years of US Treasury risk. So where we see value is the front end of the curve, where you're not taking as much risk, 2 to 5 year sector. The Fed's long-term dot implies a neutral rate of 3%, and the market doesn't have rates getting anywhere near that. Even over a year and a half from now, the market has Fed rates bottoming more like 336.
So just in 20 seconds, I got to get to the market open and we'll come back with Jamie Patton. Jamie, does TCW just say the Fed's going to sit on the sidelines?
We think they will sit on the sidelines, but we think that's a mistake. The bar for a Fed cut feels pretty high right now. They just told us that the bar is higher than it was in 2019 when inflation was lower, but we're seeing in the hard data just this month, CPI and PPI, we're seeing that inflation was coming down towards their target before this tariff-related vol. Their mandate is twofold, inflation and growth. On the inflation side, it's coming back down to their mandate, and we're going to have this volatility on tariff-related. On the growth side, we know that there's going to be a hit.
So, Jamie, here, talk to us about, I don't know, it just seems like we've got a lot of volatility in the bond market. I'm thinking back to April. A lot of people are even suggesting that the bond market might be a little bit broken here in the Treasury market. How do you think about the volatility in the Treasury market? Is it functioning well at this point for you?
It's definitely functioning, and it makes a lot of sense. A steeper curve, higher term premium, as we discussed prior. You should get paid more to take more risk in this environment, whether that's credit spreads, whether it's the shape of the yield curve. It's definitely functioning, and it's definitely orderly. It's definitely liquid, and we don't really see any problems there. Even everyone's talking about the U.S. downgrade. That feels like old news. We agree with Besant's comments over the weekend that it's the third of 3 rating agencies. It's backwards looking. We started talking about this in 2011. I heard you guys talking earlier that we've been talking about the deficit since, 1980, probably prior to that. There's no real new news here. What's new is that investors might be realizing that they are globally over-allocated to U.S. assets. And that's a very different story than the U.S. dollar losing its exceptional status as the reserve currency. Those are two totally different topics. And even what's kind of amazing is that it's one of those situations where even if we have high conviction in this, but even if we're wrong, the Fed has tools that it can use if the bond market ever stops functioning that they're really comfortable with. After rate cuts, quantitative easing is a tool that the Fed's been most comfortable with and been employing for over 15 years. So we really like trades where we have strong conviction, and even if we're wrong, someone like the Fed could come in and fix it. So we're not worried about treasuries. We're not worried about bond market functioning.
So what is the key issue for you guys here going forward in the next 3 to 6 months?
The Fed. We see the Fed. The Fed is in a really precarious position, but they have a dual mandate. On one side of their mandate, they can actually impact change. So we know from all of the soft data that growth is really in trouble. Uncertainty does not, if you're sitting here with maximum uncertainty and you're leading a company, you're probably not like, let's open 4 new facilities and like increase our inventory and come out with these big growth plans. You're kind of just frozen, waiting to see what happens. On the other side, you have inflation. We see inflation coming down prior to the tariffs. We know that there's going to be a lot of vol and headline and noise and all that stuff once the tariff hit the data, which is probably this and next month. But the Fed can't really impact that. Even if Fed rates were at 15%, tariffs are still going to raise prices. So if you have a dual mandate and you can impact one side of it, you can't really help the other side. I would probably be more attuned to the side that I can actually impact. The Fed, on the other hand, has told us very clearly they are in a holding pattern. Right. They're waiting and seeing. What's interesting, everyone loves flying analogies, but they don't really make a ton of sense here. The Fed is sitting here in very restrictive territory, over 130 basis points into restrictive territory, according to their own forecast.
Right.
When you're in an airplane and you're in a holding pattern, you're not accelerating, you're not decelerating, you're not coming in for a landing. So they're decelerating. Their speed brakes are on, yet they think they're in a holding pattern.
Jamie,
so that's where potential for a policy misuse.
Got to run. Jamie Patton, thank you so much for TCW this morning.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.